What's going on, Law Nation? Welcome to the Passive Income Attorney Podcast, your favorite place for learning about the world of alternative passive investments so that you can have more freedom, flexibility, and fun. If you're ready to kick that billable hour to the curb, start by going to attorneybydesign.com to download the Freedom Blueprint, which will also get you access to opportunities to partner with us on one of our next passive real estate investments. We'd love to get you on board, get you on your way to your first or your next passive deal and income stream. All right, today's topic, let's talk a little bit about good sponsors and gut feelings. Now, when we're talking about passive investing in real estate, in a real estate syndication, we've already established that out of the sponsor, the market, and the deal, the sponsor is by far the most important out of the three. And that's because the people running the show are the ones that are going to determine the outcome of success on your projected returns and your hard-earned capital. But how do you really know who you're investing with? How do you really know that the people that you give your hard-earned cash to are going to be good stewards of your money, and they are going to do everything in their power to make this a successful investment for you? Well, unfortunately, you don't. There's only so much you can do. Of course, you got to do your due diligence. You've got to do the things, the fundamental things. Make sure you check their track record out. Do your Google searches. Ask around. Do your networking. Make sure that these people and their backgrounds check out and that they are who they say they are. Make sure they've had success in their past real estate deals or their past businesses and their careers. Make sure that they have a track record of ongoing success. And after you do all that, though, what do you need to do next? You really need to take that call. You know, that everyone asks for, including myself. I say, jump on a call with me. Let's talk about your financial goals, or let's talk about this deal. What questions do you have? Take that opportunity, take that call, and trust your gut. What does your gut tell you? Do you get that good feeling that, one, they're not only, they need to be intelligent, they need to know what they're talking about, they need to understand the investing space and the investments in the real estate or the business or whatever it is that their business is, right? So they have to be competent. They have to have the intelligence and the knowledge to be competent in their space. And the second thing is, what do you think about them as far as character is concerned? How do you feel about them? Are they just trying to sell you something? Of course, we're all in the sales game, right? We're selling ourselves to a significant other or a date, or we're selling cars or houses or businesses or whatever it is. But are you just being hard sold? Or do you really feel like they care about you and their investment and they're passionate about what they do and they are good people and they are trustworthy and transparent? So that's really what is the qualitative over the quantitative. You're not going to be able to put that on a spreadsheet and say, this sponsor is better than this sponsor because he gets a 10 out of 10 and this person gets a 7 out of 10. It's all about that gut feeling. And sometimes you just have to trust it. So our awesome guest today, Omar Khan, is the founder of Boardwalk Wealth and has over 10 years of investing experience across real estate and commodities. He's advised on $3.7 billion of capital financing and M&A transactions and has syndicated huge multi-million-dollar deals across the U.S. And he's an expert at passive investing, and describing that qualitative versus quantitative description of how you evaluate a sponsor. Without further ado, let's jump in.
This is the Passive Income Attorney Podcast, where you'll discover the secrets and strategies of the ultra wealthy on how they build streams of passive income to give them the freedom we all want. Attorney Seth Bradley will help you end the cycle of trading your time for money so you can make money while you sleep. Start living the good life on your own terms. Now, here's your host, Seth Bradley.
Omar, what's going on, brother? Welcome to the show.
Hey, Seth. Thank you for having me. Very excited.
Absolutely, man. Absolutely. Glad we're finally able to get you on the show. Well, let's just jump right in, man. Tell us a little bit about your background, your story, and feel free to take it back as far as you'd like.
Sure. Look, it's not as exciting as maybe some of your other guests. I'm a finance guy. My family has been in business for a long time. So, we had the whole personal background is in that, professional background within running and structuring deals on the institutional side. Started kind of this business not because of any of those reasons, because we had a tax problem, a good one. We had a lot of gains. We wanted to shelter taxes, and given my background professionally in running and structuring deals on the institutional side for a decade plus, some of the personal background with regards to the family being in business, being commercial real estate investors, I just had a good exposure to all the tax write-offs and all of those sort of things. Obviously, that's knowledge that keeps building over a period of time, right? So we had a problem, tax case, wanted to shelter it, had a good personal and professional background, and that was basically the start and impetus of the journey. Basically, I wish I had a cooler story. Like I always wanted to do this, any of that stuff.
Yeah.
So
Well, I
that
mean,
was that in a nutshell.
yeah, I mean, taxes are always a good reason, man. And that's a great reason to get into real estate are the tax benefits. And I think some people might not think of that. They just think of real estate as a good investment. They don't take into account, sometimes when they compare, let's say, stocks to real estate, they don't take into account, they're like, oh, I can make, 12% on stocks and I can make about the same in real estate. But they don't take into account the tax benefits, which are huge.
Yeah.
So that's not.
Yeah. Plus, I think one should do both things. I've always never understood with people. I just do this for that. I'm like, well, we're lucky to live in a country with so many options, so many opportunities. Why not partake in everything that can help us get ahead in life, financially at least?
Yeah, it's not just about what you make, it's what you keep. So
Exactly.
The tax piece is super important, especially for a lot of our listeners out there that are, W-2s, they're lawyers, they're doctors, folks like that. So we get taxed like crazy. I mean, Uncle Sam is always in our pocket. So a super important issue for our listeners.
The pain, man. We have the same issue. Yeah, but I think you're a lawyer, right? Yeah, you're a lawyer, obviously,
Yep.
Right? I was in finance. My wife's a physician. Dude, I mean, it's just like I've told a lot of people, look, if you forget about ever getting a salary raise or any of that stuff, if you just optimize your tax problem, as an example, let's assume whatever. Look, if your household income, you make like whatever, say $300,000-$500,000 a year, you're paying at least $100,000 in tax minimum. I don't care where you live in the country. It's going to happen, right? Dude, you even save like say half of that. Say you pay 120, you save half of that, $60,000 a year. That's $5,000 a month. I mean, that pays for your kids' college education. That pays for your vacation. That literally takes care of a lot of problems. That pays for a bigger house and a bigger mortgage, in case you wanted to go down that path. And you can do a lot of damage with $5,000 extra of pure cash a month.
Sure. Yeah, absolutely, man. So tell us a little bit about your current business. What is it? And tell us just a little bit about that.
Look, so the primary business is development and acquisitions. So we do both. We do develop from ground up as well as acquire multifamily. So the acquisitions is obviously more opportunistic, value add, that sort of stuff. We have a couple of Class A core holdings as well. The developed market obviously is opportunistic in the sense that we need to get like land at a cheap rate. There's got to be some story there, but that's obviously newer Class A buildings. And we've had our portfolios in Texas, Georgia, Florida, and South Dakota. We're obviously looking to expand in other areas, but we try to keep a focus in a couple of areas because there's only so many battles you can fight in a day, right? And a lot of this is still a relationship business, right? So the more you do, the stronger your relationships in a certain locality or a certain jurisdiction become.
Yeah. Now you're on the active side. So tell us about, when you decided to go into real estate, why did you decide to jump into kind of that active side? I'm going to start trying to find these buildings. I'm going to try to buy them rather than, let's say, go to the passive side.
So look, in my particular case, as I told you, I was actually running and structuring deals on the institutional side. So luckily for me, this is pure luck. This is not like by design. I actually had experience on the investment sales side, both as an advisor and as well as on the buying side. So for me, when I had this tax problem, it was very obvious that for me to take big swings and get this problem solved, I had to get I had to have like a lot of write-offs. So me investing 50, 100 grand, 200 grand wasn't going to get me there again, because I was in a very privileged and lucky position with the gains that we had on a couple of investments. So that's why it was a combination of personal circumstances and professional background. For instance, I could have had the same tax situation, but if I wasn't running and structuring deals, didn't have the investment sales background, I might have actually done passive because didn't have those resources at my disposal, right? So a lot of this came down to having the problem, having the resources, and then marrying them together.
Yeah, that makes sense. And the reason I'm asking is just because a lot of our listeners are lawyers, they're doctors, they
Yeah.
have a full-time W-2. And I had a similar experience at working in big law, and I'm billing 3,000 hours a year, and I started trying to flip houses. That was my dive
Oh,
into real
dude, you
estate.
have a high threshold for payment.
And trying to do things like that while you're working full time, and especially as a professional that's making a lot of money salary wise, it
Yeah.
just doesn't make sense. I didn't see it then, obviously at the time, but looking back now, I'm like, why in the world would I do something like that that takes all this time, all this effort, all expends all my decision making capabilities in the day, to make just this little bit of money when I could give
Yeah.
my money to a professional, an expert like yourself, and invest passively and still get great returns.
Look, I 100% agree with this. And it's a joke, again, because my wife's a physician, so I get to meet a lot of her friends who are physicians. And I always joke with these guys. And for whatever reason, a lot of guys, some guys get it, like same with lawyers, same with doctors, accountants. Some guys and girls get it. Most high paying income professionals, for whatever reason, it takes them a little while. And hey, you make your 200, 300, 500 grand over here as a household income, yet you're ecstatic about doing the job of somebody that makes $20 an hour over the weekend. Like, this makes zero sense. Like, a lot of these guys tell me, and these are, say, a doctor couple that might make $1 million a year, right? And they tell me, oh, I'm cash flowing $250 on my house. I say, bro, you make $1 million freaking dollars a year. Why are you so excited? What are you going to do with this $250?
Right.
Right? I mean, it's not even a rounding error in your mind, right? I mean, but it's kind of hard to break through. But the intelligent people, when they get it, they literally just go all out. They're like, yep, look. And like, for instance, if I need an attorney, I'm going to hire you. I'm not going to go to law school myself, right? If people somehow get it in those spheres, but it takes them a little while to understand on the investing side.
Yeah. Sometimes they need somebody to explain it to them, to like point that out and say, oh, you're excited.
No,
about
you're
250
right.
It's like, oh, you're excited about $250 a month. It's like, yeah, that's great. But how much effort did you put in to do that? First of all, I mean, you had to
Exactly.
find the house, you had to rent it out, you hired a property manager, maybe you did some construction, maybe you're doing the maintenance yourself if it's close, like stupid stuff like that. And you're like, well, wait a minute, dude, think about this. You make all this money. Why in the world would you do that?
Seth, but I think I've come to the realization, I think a lot of this has to do with the fact that, at least for high income earner professionals, at least. Look, my brother-in-law is an example. He works at a very big tech firm, makes a boatload of money. It's taken him a little while. He's very good with his money. He's a very smart guy, right? I mean, I couldn't be as smart in a million years as how smart he is. But it's taken him a little while because I think a lot of this is ingrained into the fact that, hey, I just need to read another book. I just need to take another course, because that's the way we solved all our problems in life, right? Hey, do better in school or study harder. It's just a product of putting as many hours as possible. And a lot of times it's not in life, like, dude, it's not just about working hard. You can't just, there's only 24 hours in the day and there's so many things you've got to do. So it takes a little while. You're right. You have to have the right person explain these things to them. But it's very surprising that how many people want to do a $20 an hour job when they're billing out at $300 an hour.
Right. Sometimes that's right. It's a mindset shift. I know for me, it was. I grew up with a blue collar background, so it was always trading dollars, trading time for dollars, and just working really, really hard if you want to get something. And that's all. That's the only answer to any question is work harder.
Work harder, right? Do more hours, basically.
Right. Work harder, put more time in, rather than asking, well, who's the expert? Who can help me?
Yeah.
Who, not how, right? That book.
Oh, I swear to God, you took the words out of my mouth. I was actually going to recommend that book because I'm a strategic coach. Wow, you took the words right out of my mouth.
Yeah, it's a great book. I mean, that's part of that mindset shift is who, not how. Not how can I do it? How can I put in more work and more time to get to where I want to get? It's who can help me get there? Who can expedite that process? Especially, like I said, with folks that are doctors and lawyers and have good income. You have the capacity, you have the means to hire somebody that's an expert. You don't have to read a book to try to.
And the other thing there also is what's always surprising is, look, especially if you're a doctor, lawyer, to a certain degree, accountant, you basically had to be on your A game since you, like, kind of even before high school. Right? Because you got to nail it in high school to get to a really good school. You got to crush it in your undergrad to go to medical school or law school, right? So you've been on this, like most people have been on this 10, 12, 15-year journey of just crushing it. But it's just Everything has to be set aside. Just got to go do this. And I think to myself, well, after all this hard work, don't you kind of want to enjoy yourself a little bit? I mean, you make all this money. Don't you want to like smell the roses, kind of enjoy yourself, enjoy your kids, enjoy your wife or partner? But that's not really the case.
Yeah. All right, well, let's switch gears a little bit. Let's dive in. Let's say our listeners out there, they decided, we're not going to flip a house. We're going to skip the flip. We're gonna invest passively. What are some of the things we need to look out here for sponsors? Because you always hear, the sponsors are the most important part of the whole thing. You talk about the sponsor, the market, the deal. Almost everyone always says it's the sponsor that's the most important part. You don't just look at the projected returns and compare one deal to the next. You look at the sponsor. What are some of the things they need to look out for?
So look, I know what I'm going to say is more qualitative than quantitative, because like you said, everybody likes to, I'm going to dig into the numbers. I'm like, look, man, first of all, if the sponsor is intelligent, they're probably not even going to know what the hell's going on. Okay, let's just be very clear. It's a specialization issue, right? It's like you're a lawyer. No freaking way I'm going to know what you're doing because you advise me on what's going on. So what I tell people is, because I invest my own money with other people, right? And the two things that I'm screening for, I can tell you this. These are both qualitative things. Number one is, what is my estimation of this person's competence, right? Because, and again, it's qualitative, because you kind of find out, it's a gut feeling sort of deal. Like, do I think this person is qualified enough to do the job that they're saying they're doing, not just spewing out lines they heard online, right? And secondly, do their values match my values? Now, this again is very nebulous, because what does values mean? What does good ethics mean? It varies from person to person, right? Because in my opinion, what you don't want is somebody who's extremely honest, right? Really honest person, but a complete idiot. What's the point of that? Your money's going to be lost. Conversely, you don't want somebody to be basically a super killer, professional, number one in the world, but a Bernie Madoff type person, right? Because again, your money's gone. So for me, what's most important is the person's competence and my estimation of their character, right? Again, it's very qualitative. There's no math or science behind it. It's a gut feeling. And that's why it always helps to talk multiple times, as opposed to money having a burning a hole in your pocket. You talk once, all right, here's my money, because it might work, but it might not work also.
Yeah, I love that. I talk about the same thing. It's that gut feeling you have. Have a couple of calls with that person before you invest, or when you're interested in an investment. What's that gut feeling you get? Do you get the feeling that, one, they're competent, they're intelligent, they can actually do what they're saying they can do. They know about their industry and what they're getting themselves into and the investment that they're asking you to invest in. And two, the gut feeling about their character and what they are, how they are as a person. And do you vibe with them? I mean, you're going to be a business partner with this person for 2 to 10 years.
Look, so I'm going to give you a really good example of this. Look, I have a really good investor. You're going to laugh at this. The first time I heard this, I was still kind of thrown for a loop, but I've heard the story a lot of times from various people. So I've got a really good investor, right? Super smart. She invests in a lot of people's deals. She's really astute, right? And she and I were having a beer once, and she's, like, hey, what's going on? We all discuss, okay, here I'm investing with this person. This is what I'm doing, because I know her kids and her husband and all that stuff, right? So she was telling me that this one group she's invested with, it's a reasonable sized group. I won't say they're the biggest group, but they're a reasonable sized group, right? She'd done a deal with them. She said this was the best deal in terms of returns she had ever invested in. I was like, great. How much more of your money are you going to give them? And she's like, I'm not going to give them $1. And I was like, okay, that's kind of weird. This doesn't jive up. I was like, look, their job was making money. So what's the problem? And she's like, well, the problem was, for the 2 years that we were in the thing, I was kind of always anxious when dealing with them, because number one, I send them a question or a feedback or whatever, something, right? And either it would go into a black hole, or the response I would get would not even be the response to the question I asked. And then I would ask for a clarification, and I would just get punted around. The question was never really answered, and I never really felt comfortable with that, right? And it just created an extra layer of anxiety, right? Now, if you think about it, that's something that if you talked a few times, you could maybe try to gauge, right? Just the way the person replies to questions. So again, it was the case that person crushed it, but he or she is still not going to get a lot more money, because the personal values and how you like interacting with somebody, that part didn't really jive.
Right. They checked the box for number one, but not for number two, because she got that vibe that, okay, I'm asking them a question. It's pretty
And these are
straightforward.
simple questions, by the way.
Yeah,
These are very straightforward questions.
right. And they're not answering it directly. They're answering like a lawyer.
Yeah.
I can say that because I'm a lawyer. But
Well, I can say that too. Trust me, I've had questions from lawyers. Don't get a straight answer.
but yeah, I love that. Qualitative, not quantitative. And so let's jump into a little bit of the underwriting stuff. I don't want to go too deep. We want to keep it kind of high level here. Because a lot of folks, they're going to look at that spreadsheet, even if they ask for it and they get it, or
Yeah.
just pro forma and the offering memorandum for a passive investment, they're not going to know everything. You kind of alluded to that already. Is you're not going to know the full recipe. But are there a few things or a couple of things that you could point out in that underwriting? You can do a quick look and say, look, check or not check. These are things that to kind of look out for: yellow flags, red flags, things like that. In the
Look, see, high level wise, I mean, I would say that first of all, every rule can be broken for valid reasons, number one, right? So a big thing that, for instance, people can look out is rent comps. You have to know this, that every single sponsor, every single broker, anybody who's trying to sell you any sort of deal, they're going to selectively choose the rent and sales comps that they're putting in. That's just the nature of the beast. You just have to get over that fact very quickly, okay? Now, if you're an investor, these days at least, you can basically go online. As an example, let's assume the property you're looking to invest in is ABC deal in Atlanta, right? Whatever, say Marietta, Georgia, which is in Atlanta, right? Now, you can literally go to Google, type apartments near ABC apartment building in Marietta, Georgia, and you'll get a whole host of various apartments around the place just on Google Maps, right? And then you as an investor can go to each of the pages individually. You can either go to their homepage of the apartment complex, or you can even type apartment name, apartments.com, and show up the apartments.com page, free to look at. None of this stuff costs money, right? And you can then get a rough idea. Okay, hey, this person's saying, these things are leasing for $1,000. They want to get it to $1,200. The comps around it are $500. What is this person going to wave a magic wand? What's going to happen? Or conversely, yeah, the comps around it are for $1,600. They both kind of look visually the same on the pictures. They're similar vintage. Yeah, this kind of makes sense. Again, you're doing a gut check, right? You're not trying to kill somebody in the process, right? Similarly, for instance, if somebody says, as an example, we have rents that say $1,000, we're going to take them to $1,600 because this is a highly affluent demographic, right? And then you look up the median income in the area. You can go to a website like niche.com, Zip2. I mean, literally just type, get the zip code, type the zip code, median income. You'll figure it out. I mean, it's really not that hard. This is all free stuff, right? So this person says, hey, these are very affluent demographics. But it turns out the people there make $15,000 a year. It's going to be a hard problem. It's going to be a pretty hard deal. Conversely, it might be $100,000. And you're like, kind of starts making sense. Right. So the big things for me are, especially these B plus value add sort of deals, the median income. I have tried every single thing in the book and realized that while you need to do a lot of your homework, the median income is such a good indicator of what's actually going to happen. I mean, it's kind of scary how good of an indicator it is, right? Even though it's just one data point, if you think about it, right? So median income, school ratings in the area, right, and the rent upside. Because if you kind of have that nailed down for value add deal, look, you'll figure out the rest. That's not a problem.
Yeah, I love that. Those are really high level things that, even if it's your first deal that you're invested in.
And these are all free, by the way. You can get all of this stuff free on Google within like less than 5 minutes.
Yeah. Again, you can just look these things up on Google. Easy to look up. It's things that you can just check really quickly to see if that sponsor is really, exaggerating those numbers a little bit, or kind of selecting the wrong rent comps and things like that.
So those are the high level ones. I mean, of course, we can go into as much depth as you like if you want, but high level for value add B plus type deals, you've got to be chasing at least 150, 200 units, dollars per unit and upside. That's kind of what you're looking at.
Yeah. Yeah. Any others that might be a little bit deeper?
Look, sure. Look, as an example, we can talk about rent growth all we like. Say somebody saying 3, conventionally everybody says 3, but lately, if you're in these high growth markets like Phoenix, Atlanta, Dallas, Orlando, Jacksonville, Tampa, if a sponsor puts in 4.5%, 5%, well, I mean, look, 3 years ago, you should be like, look, are you smoking crack? What's going on? Well, last year, things have gone up by 25%. So 4 doesn't sound too bad, right? A lot of this is a matter of perspective, right? For instance, the rent upside is a big one. Then basically, what is the exit price going to be? Exit price, look, if somebody's buying it at, say, like a 70s vintage property, $250,000, dude, I mean, I'm not sure on freaking, I'm probably going to take my words back in 6 months. I'm not sure on like Park Avenue, New York, you're not going to sell it for $400,000. Okay, that's just not going to happen. Okay, I know a lot of guys in Phoenix are doing this. I know this so far has worked, but you're playing with fire here, right? Just saying. So a lot of these are big ticket items like rent comps, loss to leases, vacancy numbers, and then basically what exit price are you exiting at? Because if that's above the cost of development, well, what kind of idiot would buy it off of you then?
Right. That exit price slash, that exit cap rate
Yeah.
makes a huge difference on your overall return over, let's say, a 5-year period.
Yeah.
It can exaggerate that incredibly.
So that's it in a nutshell. Again, look, you can go as deep as you like down this rabbit hole, but again, if you're a high income earner, you got to pick your poison and realize how much time do I have and do I want to go do this guy's job?
Yeah, exactly. That's the thing is you are investing as a passive investor. So how much do you want to dive in here? I mean,
Yeah.
We do this professionally and it's a full-time gig compared to you're a doctor, you're a lawyer, you're an accountant. You don't want to know everything, but you've got to spot check. You've got to hit the important points.
It's got to pass the smell test, right? It's got to fail the gut and smell test, right? Basically, does that, you're okay. And this is where screening the right people up front becomes super important.
Yeah.
Right? Because if you screen the right people, you're going to have less of these problems. If your screening is kind of weird, this is always going to be a problem.
Yeah. Yeah. For our listeners out there who haven't even invested in a deal yet, I think back to that experience of wiring that first $50,000 to somewhat of a stranger. I might have met that person a couple of months ago or a month ago. It's nerve wracking, right? I mean, you're just wiring this money to some stranger or someone you just met who they passed the smell test, the sponsor passed the gut check, but you're still wiring a big chunk of change to someone you pretty much just met. What are some of the things that you do and other good sponsors should do to make the investment experience a little bit more pleasant and comfortable and put those investors?
Look, to be very honest with you, most of my investors, they come from word of mouth. Right. And it's good in the sense that, for instance, I don't have to do any of the jumping through the hoops part because look, a lot of this is social proof, right? For instance, let's assume your wife is invested, your wife or partner, I don't know if you're married, has invested with somebody multiple times. They've done a fantastic job. They've said what they were going to do what they were going to say. So she says, hey, Seth, I think we should invest with this person again. Right? And you're at a party and you invest with this person and you're talking to a friend. And you're like, hey, my wife and I, we invested 5 times with this person. That person doesn't need a lot of convincing. Because look, you are presumably the reason why they're talking to you socially is because you're a trustworthy person. So you are going to give a trustworthy recommendation. So a lot of this boils down to how good your word of mouth is from existing investors. So for me, in my case, 90% of my new business is from word of mouth investors. So I've had less of these issues. But the other thing also is what I tell people is a lot of times, look, ask as many questions as you like, because I tell them up front, I was like, look, once you send the money and the deal is live, it's not like you can press a button and the money is going to get liquidated, right? I mean, here you go, here's your extra 50 grand. So really think about it. And a lot of this boils down to measuring twice and cutting once, that old adage. And frankly, you can create a better and better customer experience. But at the end of the day, if you're not a reliable person, none of the customer and experience of the journey you create is going to work. So a lot of this, it boils down to this thing about screening people up front. A lot of this boils down to screening. It's so funny that I have lots of lawyers and accountants, and especially finance guys, because they think everything works on a spreadsheet, right? I mean, I'm a finance guy, right? In life, things work on a spreadsheet, but you can't put somebody's level of honesty on a spreadsheet. There is no score for that yet, right? So that's where, for instance, screening the right people up front, having multiple conversations, not being in a hurry to give your money to somebody, that really comes through no matter what way you get it. It's all about the front screening. So if you've got, say, an hour only to think about an investment, spend 59 and a half minutes just on screening the person. The rest of the stuff doesn't even matter, relatively speaking.
Yeah. Yeah. I mean, that kind of highlights one of the big mistakes I see new investors make, and they're just comparing deal 1 to deal 2. looking at basically just projected returns. Like,
Yeah.
okay, this one has a 18% IRR and this one has a 16%. So this 18% deal's got to be better. I'm going to invest in
Yeah.
that deal. They don't even look at the sponsors. They don't look at their track record. They don't get that gut feeling test. They just say, oh, this has a higher projected return, so I'm going to invest in that one. And that is the wrong way to look at it.
Yeah. And look, good sponsors, by the way, you'll also realize good sponsors typically have, on paper at least, lower numbers than other people do. Because they don't have to hustle that hard for your cash. They don't have to go convince people, hey, I'm the best person in the room or I'm the best steward of your capital. So they don't have to go make outlandish promises. And for some people it works and for some people it doesn't. So that kind of boils down to your personality as an investor and a person also.
Yeah, that's a great point. I mean, the underlying deal itself as well, if it has lower returns, it everything else being equal, it probably has less risk if everything else is the same.
Yeah. But again, experienced sponsors, they don't have to convince people. A lot of times people talk about sales taxes. How do we get people? And I'm like, look, if you're a solid sponsor with a good track record, there is some element of salesmanship. Don't get me wrong. All of this work is sales. But you don't have to jump through so many hoops because you're like, look, dude, here's a list of stuff I've done in the past. Here's a list of stuff I'm doing right now. There's a line outside the door. Let me know when you make up your mind.
Exactly. And that's
it is like that. Yeah, it is like that. Right. And that emphasizes the point, actually.
Yep. Yeah. Well, walk us through maybe what happens after closing. What happens after, you send that wire and sometimes it's dead air,
No. So anybody who does that, you never give them a dime of your money. I don't care how good they are. So I don't know about other people. I can tell you what happens in our case. What happens in our case is that because I have gone through this experience, so I don't just mentally, I don't want other people going through this, right? About the dead air part, but I had to confirm, hey, did you get the money? And then wait a week and you're nervous. And yeah, I got the money. I'm like, dude, you could have just told me this a week ago, right? So look, in our particular case, we like multiple touches, both pre and post. So pre basically is a lot of times investors ask, oh, where do I send the money? I say, look, man, the exchange consideration or the exchange of money, this happens right at the end. Number one, we have talked, You look at the deal, you approve it. If you approve it, then you look at the legal documents. You read them, you review them, you sign them. Once that is done, and we confirm from our side, hey, you're in, then and only then do you transfer the funds. And by the way, when you transfer the funds, I always tell all the investors, look, first of all, because I'm sending you this through a secure portal, you still have to call me or my investor relations person manually, like over the phone, pick up the phone, manually confirm the account and routing details manually. And I say, or my investor relations guy says, yes. Then you send the wire. You send us an email saying, I have sent the wire. And from our side, we will get back to you within 24 hours saying, yes, we have received the money. So there is like this 3 or 4 step process. And some people say, oh, why do I got to go do that? I'm like, look, man, frankly, it's your money. I don't really care if people burn that money. I have to follow my set of processes, right? So that's the set of processes we do. So this is like, hey, you send me the money, we get it. Now, post-closing, what happens is that every month, you'll be getting constant communications from us on a monthly cadence. Anytime there's a material event that happens, so for instance, a tornado happens or there's a fire. It hasn't happened yet, but let's assume there is a fire. Hopefully it never happens, right? We will let you know. So it's monthly. Every time there is a material event happening, every quarter you will get the financials plus those continuous monthly updates. Every year you will get the K1 plus those constant monthly updates plus the financials. So we are always in touch with you. So there are, say, for instance, certain of my investors, they're in like 8 or 10 of our deals. So per month, apart from like the mail, the email stuff that we send out every 2 weeks, they're getting like 10 or 12 emails from us. But they're from different deals because we have to keep them apprised about what's going on.
Yeah.
So that's the flow of the communication of what happens.
Yeah, no, that's great. I mean, it just gives you that extra layer of comfort. And when you keep that line of communication open, even if it's an email about a new deal or a financial update on how the rehab's going, things like that, it just lets the investors know, hey, we're still in this with you. We're still doing work on our side. We're still working to get those returns that we promised you.
Yeah, and look, a lot of this is just not even to date. I can tell you this: I have yet to receive it. Because again, maybe we're in communication with investors frequently. To date, I have yet to receive some sort of a left field question. I mean, it's always like, hey, what do you think about this? Are you going to sell this next year? XYZ has happened. Are you concerned about this? Nothing profound. I mean, Jesus Christ, we're in real estate, man. There is nothing profound here.
Yeah, business has been around as long as time.
Yeah, I mean, you're not right to recreate the wheel here. We're not Elon Musk. At least I'm definitely not Elon Musk.
All right, Omar, before we jump into the Freedom Four, what's one last gold nugget for our listeners?
Look, the golden nuggets is that same thing. It's about having patience and, like I said, measuring twice and cutting once. Do not ever tell people, anyone, look, I'm a sponsor. Do not even tell me this, right? That you just have to go invest this money. Because I'm telling you, the day you say this thing, people start treating you like a walking, talking ATM, right? Don't do that. Take your time. Just realize that you might think, oh, inflation is 7%. My money's sitting in the bank. It's a lot better than losing all your money. Okay, 7% a year is still going to take what, 14, 15 years to lose all of your money versus losing it all in 1 year. So think about that. So measure twice, cut once, and be a little patient.
There we go. All right, let's jump into the Freedom Four.
It's time for the Freedom Four.
What's the best thing you do to keep your mind and body healthy?
Oh, dude, I should be exercising more. I don't. I've got 2 kids, but that's just my excuse. With regards to mine, I like to read a lot. I just generally like to read. Sleeping, I think 7 to 8 hours is essential. I'm not really there yet with kids. And apart from that, I keep myself mentally engaged because I'm very lucky to have a lot of great investors in multiple fields. So just by talking to them, I'm keeping myself mentally engaged all the time. But physical part, I need to get better on.
Love it. You get there, man. With all your success, what is one limiting belief that you've crushed along the way, and how did you get past it?
Look, I think there's always a fear of the unknown, right? Or rather the fear of, hey, if I do this, what happens? So I wouldn't say it's less of a limiting belief, and it's always a thing that for me at least is, hey, you get to a goal. Now to get to the next goal, there's always a limiting belief. Can I get there? Will I get there? Will I lose a lot of money? So that limiting belief, that the ceiling of that limiting belief is going up. So I've crushed certain levels of that limiting belief, but that ceiling is going up. So I haven't completely solved that problem yet.
Yeah, no, I love that.
Like I'm not limitless as an example. Where some people are like, hey, we can do everything. I'm still not at that stage yet.
Yeah. What's one actionable step our listeners can do right now to start creating more freedom?
Diligently start managing, like recording your time. Forget about managing it. So for instance, I'm a slave to my calendar. My wife, my mother, my parents, everybody used to make a lot of fun of me. Hey, because I tell them, look, it's not on the calendar, it doesn't exist, right? They used to make fun of me. They don't make fun of me anymore because you have to diligently manage your time, especially if you're a high income working professional, because time is the only thing we don't have or we can't make more of. Even with our money, we can't make more of it. So measure it, because once you start measuring it, you start realizing how much time you're wasting. Then you can start optimizing it.
Do the same thing, man. I say if it doesn't make the calendar, it doesn't exist. It does not exist.
And it turns off a lot of people. It's really weird. Like a lot of my friends, they don't get it. I'm like, dude, it's just the way it is, man. What do you want me to do about it?
Yeah. Last but not least, how has passive income made your life better?
Oh, shit, are you kidding me? Like, it's made it better in all sorts of ways. When I look around, for instance, people who are, say, more intelligent in better corporate careers, so I'm not in a corporate career anymore, what it's given me is time freedom to a certain degree. I don't see that with a lot of working professionals. People who are, say, more intelligent, got better grades. Time is the one freedom they don't have. And we have that to a certain degree, not completely. And that's the one thing I'm most grateful about.
Yeah, that's awesome, man. It's all about time and creating the flexibility with that time.
Yeah, flexibility, because I feel most people aren't averse to working. It's just you don't want to be put in a rigid box of, hey, you've got to do this at 10 a.m., right? When there's no, it's an artificial deadline, basically.
Yeah. Us as entrepreneurs, we have a million things to do every day and we fill up that calendar. But if something comes up and we have to be somewhere at a certain time or this half a day, we can clear that schedule.
Dude, like for instance, I've got kids now, and anytime, some of my kid is wants to go out or does something or kid's sick, I have the flexibility to a certain degree, not always, to be like, all right, we're just going to do it with the kid. I don't really have to be bothered about it. And I can move my calendar around if the need arises.
Yeah, exactly. All right, Omar, this has been awesome, man. Where can our listeners find out more about you?
Well, you can go to our website, boardwalkwealth.com, BOARD, Walk Wealth. I think you'll have it in the show notes, right?
Yes.
Right on the top right, you'll see around, I'd say 30% of the way down from the right, you'll see an email opt-in page. There's name, email, how you found out about us, fill it out, you get an email, click on the link to verify yourself because your email provider knows we're not spamming you when you click on the link. Or you can reach out to me, Omar, OMAR, at boardwalkwealth.com. Happy to answer any questions, help you in any way that I can.
All right, brother. We'll drop all that in the show notes. Appreciate you coming on today.
Thank you, sir. Have a good one. Thank you for having me. Bye.
All right. Omar Khan, my good buddy from Boardwalk Wealth, always has a wealth of knowledge to drop on everyone. And today was no exception. I especially loved how he talked about the qualitative versus the quantitative way to evaluate a sponsor and how you go about doing that and trusting your gut. And that is the major key for today. Trust your gut. Take the opportunity to take that call with the sponsor you're considering investing with, and ask yourself, how does it feel? And once you decide, trust it. All right. If you're ready for a change and ready to take action, partner with us on one of our next passive real estate deals. Go to passiveincomeattorney.com and join our Esquire Passive Investor Club. All right, kids, as always, enjoy the journey.
Thank you for listening to the Passive Income Attorney Podcast with Seth Bradley. Do you want more ideas on how to generate multiple streams of passive income? Then jump over to passiveincomeattorney.com for show notes and resources. Then apply for the private Facebook community by searching for the Passive Income Attorney on Facebook. And we'll see you on the next episode.